Welcome to Valkyrie Simple Finance. Understanding before investing. This is a complete personal finance series, from basics to real-world decisions. So whether you're just starting or fixing past mistakes, this is where everything begins. Most people don't have a money problem. They have a money understanding problem. People think personal finance is about earning more or finding the perfect investment, but that's not where most people go wrong. Personal finance is about what happens after the money hits your account, how you spend it, how you protect it, and how you plan its future. Every personal finance decision answers 3 questions. Can I afford this? What happens if something goes wrong? And what does this mean for my future? Imagine 2 people earning the same income. One knows where their money goes, the other doesn't. 5 years later, their financial lives look very different. Without a system, money leaks away quietly, through small choices, subscriptions, impulse spending, and you only notice when the pressure builds. Beginners usually make the same mistakes. They focus on investing too early, they ignore risk, and they underestimate small decisions. Here's the rule to remember. Control comes before growth. Always. That's why this series starts with the basics. Budgeting, emergency funds, debt. Only later do we talk about investing. Personal finance isn't complicated, but it is foundational. When you understand the system, everything else becomes easier. In the next video, we'll look at budgeting and why most budgets fail. Most budgets don't fail because people are bad with money. They fail because the budget was never realistic. People think budgeting means restriction, cutting everything fun, tracking every penny. That's why they quit. A budget isn't a punishment. It's a plan for telling your money where to go, instead of wondering where it went. Every working budget has 3 parts: what you must spend, what you choose to spend, and what you set aside for the future. Needs keep your life running. Housing, food, utilities. Wants improve your life, but they're optional. Most budgets fail here. People underestimate wants. They forget irregular costs, and they budget for who they wish they were, not who they actually are. A working budget is simple. Fixed costs first, savings second. Everything else is flexible. That flexibility is what makes it sustainable. 2 people earn the same income. One budgets perfectly on paper. The other budgets simply in real life. Only one sticks with it. Here's the rule. If your budget makes you feel guilty, it won't last. Budgeting creates control. Control creates safety. And safety lets you plan ahead. Most financial stress doesn't come from big disasters. It comes from small surprises you weren't prepared for. When money is tight, every unexpected expense becomes a crisis. Not because it's large, but because there's no buffer. An emergency fund is simple. It's money set aside for problems you didn't plan for. Not holidays, not shopping, just emergencies. Emergencies are things like job loss, medical bills, urgent repairs. They're predictable in type, just not in timing. Without an emergency fund, people turn to credit cards, loans, or selling investments at the worst time. That's how short-term problems cause long-term damage. You don't need a perfect number. A good rule is 3 to 6 months of essential expenses. Start small, build gradually. Emergency money should be easy to access and boring, not invested, not locked away, just available when you need it. The biggest mistake is trying to invest before you're protected. Growth means nothing if one bad month forces you backwards. Two people face the same unexpected bill. One panics, the other pays it calmly and moves on. The difference isn't income, it's preparation. Here's the rule. Emergency funds buy time, and time buys better decisions. Budgeting creates awareness. Emergency funds create safety. Once you're safe, you can deal with debt properly. That's what we cover next. Emergencies aren't rare. They're part of life. An emergency fund turns panic into inconvenience. In the next video, we'll explain debt, good debt, bad debt, and dangerous. Debt isn't always bad, but misunderstanding debt is one of the fastest ways to lose control of your money. Some people say all debt is evil. Others say debt is how you get ahead. Both are incomplete. Debt is borrowed money that pulls future income into the present. The real cost is time and interest. Not all debt behaves the same. It falls into three broad categories: good debt, bad debt, and dangerous debt. Good debt usually helps you increase income or build long-term value. It's structured, it's planned, and it fits your budget. Bad debt doesn't build value. It funds consumption and fades quickly, but it's usually manageable if controlled. Dangerous debt grows fast and offers nothing in return. High interest, minimum payments, no clear end. This is where people lose years. Interest determines who benefits from the debt. Low interest buys time. High interest removes options. Most people make the same mistakes. They focus on monthly payments. They ignore interest rates, and they treat debt as normal. Budgeting creates control. Emergency funds create safety. Debt management prevents backsliding. Once debt is under control, saving and investing finally work. Here's the rule. If debt limits your future choices, it's a problem, no matter what it bought. Debt is a tool. Used carefully, it can help. Used casually, it compounds damage. Understanding the difference is what matters. In the next video, we'll look at credit cards, how they really work, and why banks love them. Credit cards are one of the most common and most misunderstood financial tools in everyday life. They look convenient, but they're designed very carefully. Credit cards feel easy. You don't see money leaving your account. You get rewards, and payments are delayed. That comfort is the point. A credit card is a short-term loan attached to your spending. Every purchase is borrowed money until it's paid back. Banks don't make money when you use credit cards perfectly. They make money when balances are carried and interest runs. Minimum payments are designed to feel manageable, but they stretch repayment over years, not months. High interest turns small purchases into long-term expenses. The problem isn't one swipe. Rewards feel like free money, but they only work if you never pay interest. Otherwise, the rewards cost far more than they return. Used correctly, credit cards can be useful. They offer protection, convenience, and flexibility, but only with discipline. Most people make the same mistakes. They spend for points, they normalize carrying balances, and they underestimate interest. Here's the rule. If you don't have the cash today, think carefully before using credit. Convenience should never cost control. Budgeting creates awareness. Emergency funds create safety. Debt management creates stability. Credit cards test all three. Credit cards aren't evil, but they're not neutral either. They reward discipline and punish drift. In the next video, we'll look at saving versus investing and why cash alone won't build long-term security. Interest rates quietly influence almost every financial decision you make. They affect your savings, your investments, and your debt, yet most people don't really understand them. An interest rate is simply the price of money. If you borrow money, you pay that price. If you lend or invest money, you may earn it. When you borrow, interest increases what you must repay. Higher rates mean higher costs. The longer you take to repay, the more interest accumulates. Some loans have fixed rates. The cost stays the same. Others have variable rates. The cost can rise or fall. Variable rates add uncertainty, and uncertainty changes risk. When you invest or save, interest can work in your favor. Returns increase your balance, and if reinvested, they begin to compound. The same mechanism, different direction. When central interest rates rise, borrowing becomes more expensive. Spending often slows. Investment returns may adjust. Asset prices can move. When rates fall, the opposite often happens. Interest rates influence behavior. Consider two borrowers. One locks in a low fixed rate. The other takes a variable rate. Just before rates rise, the difference over time can be substantial. A difference of 1 or 2% may seem small, but over years, it changes total costs. Dramatically, interest magnifies time. Debt can feel overwhelming, not because of the numbers, but because of the pressure. The good news is this: there is a clear way out. Before paying debt down, you must stop it from growing. That means no new borrowing, no new balances, no drifting. Control first. Write down every debt, balance, interest rate, minimum payment. Clarity reduces anxiety. If you don't have a small emergency fund, build one first. Even a modest buffer prevents new debt when life happens. There are two common repayment strategies. The snowball method, pay smallest balance first. The avalanche method, pay highest interest rate first. Both work. Choose the one you'll stick to. High interest debt works against you every day. The faster you eliminate it, the more future cash flow you free. Make minimum payments on all debts. Focus extra payments on one at a time. When it's gone, move to the next. Momentum builds confidence. Most people slow themselves down. They refinance repeatedly. They celebrate too early, or they lose discipline. Consistency beats intensity. If interest rates are extreme, you may consider consolidation or refinancing, but only if it reduces total cost, not just monthly payments. When debt reduces, cash flow improves. That surplus becomes your opportunity, savings, investing, freedom of choice. Here's the rule: debt freedom is not about speed, it's about direction and discipline. Budgeting creates control. Emergency funds create safety. Understanding interest creates awareness. Debt repayment creates momentum. Momentum changes everything. Debt is not a character flaw. It's a financial condition. With structure and patience, can be reversed. Start with clarity. Stay consistent. Move forward. Saving feels safe. Investing feels risky. But long-term security requires understanding both. Many people treat saving and investing as if they're the same thing. They're not. They solve different problems. Saving is for stability, emergency funds, short-term goals. Planned expenses protects you from disruption. But saving alone has limits. Cash rarely grows faster than inflation. Over time, this purchasing power declines. Investing is for growth. It allows your money to work over time through compounding, but it comes with fluctuation. Saving protects value. Investing increases value. Saving reduces short-term risk. Investing accepts short-term volatility for long-term gain. The most common mistake is trying to invest without enough savings. When markets fall, fear forces bad decisions. Savings create stability. Stability allows patience. Patience makes investing work. They are not opposites. They are partners. First, build your emergency fund. Then eliminate dangerous debt. Then begin investing gradually. Sequence matters. Here's the rule. Save for what might happen soon. Invest for what will happen eventually. Saving keeps you steady. Investing builds your future. Confusing them slows both. Understanding them strengthens both. Most people look for the perfect investment, but the real advantage in finance isn't finding the perfect moment. It's understanding time. Compound interest is simple. You earn returns, not only on your original money, but also on the returns that money has already earned. Growth begins to build on itself. If you invest money and it grows by 10%, the next year's growth is calculated on a larger amount. Over time, small percentages create large differences. Starting early matters more than investing perfectly. Someone who starts modestly at 25 often ends up ahead of someone who invests more, but starts at 45. Time is the multiplier. Compound growth rewards consistency, regular investing, long horizons, patience. It does not reward panic. Short-term volatility can interrupt compounding if you react emotionally, but over longer periods, discipline allows growth to resume. The most common mistake is waiting for more income, waiting for perfect timing, waiting for certainty. Delay is expensive. Compounding is powerful, but it's gradual. It's not dramatic in the beginning. It becomes powerful because it continues. Budgeting creates control. Emergency funds create safety. Debt management protects stability. Saving builds the base. Compounding builds the future. Here's the rule. Start early. Stay consistent. Avoid unnecessary interruption. Time will do the heavy lifting. Compound interest isn't magic. It's mathematics plus patience. The earlier you understand it, the more powerful it becomes. Most people try to fix their finances by focusing on one thing: more income, better investments, less spending. But personal finance only works when the system works together. This series was never about quick wins. It was about building a system that works consistently over time. It starts with control, understanding where your money goes, building a realistic budget. Without control, nothing else holds. Then comes safety. An emergency fund protects you from setbacks. Without safety, progress is fragile. Next is awareness, understanding debt, credit, interest rates. These determine how money flows and how it can work against you. Then comes action, reducing and eliminating debt, freeing up cash flow, turning pressure into progress. Only then does growth begin. Saving builds stability. Investing builds the future. Together, They create momentum. And finally, time. Compound interest rewards patience. Inflation tests discipline. Time amplifies every decision. When these pieces work together, something changes. Money becomes predictable. Decisions become clearer. Stress reduces. You're no longer reacting. You're in control. Most people skip steps. They invest too early, ignore risk, or rely on income alone. That's why progress often doesn't last. Here's the rule. Stability first, growth second, always. Now that you understand how personal finance works, the next step is learning how investing really works. Not speculation, not guessing, understanding. Personal finance isn't about perfection. It's about clarity, consistency, and time. Get those right, and everything else becomes easier. Start the next playlist when you're ready, and keep building, one step at a time.